Let's read some quotes. This looks complicated. It's not as tough as it looks, but you have to go slow and pay attention as to what's going on. If you're going to get involved on a regular basis and start looking at things on the market, get the hang of reading this electronically, whichever way you can possibly do that, whichever way you're looking. Okay, here is a standard thing. This is the Kellogg Company. Okay, you'll see all the different data you're going to need on investing right here, pretty much, except for the overall analysis as to what you want to sit down and look at as for part of your portfolio. But on a regular basis, they post this daily. Previous close, it's right over there, $73.96. The open today was $74.85. You have a bid and you have an asking price. Remember, we mentioned the bid and ask before. You'll see here that they're just cents apart. So you're going to end up paying 2 cents above the actual bid price, and that's a little bit different. You can see the days range. Okay, you can see the 52-week average between them. So that'll help you get the hang of, whoa, this stock once upon a time was $59.54, and it's go. So I'm near the high right now in the range. That's 76.45. That really is today's range. But look at over here, the bid and ask price is a little bit above that. So right now you can determine that this is the highest price that stock has reached over here. How much volume? 1.5 million shares. If you're going to pay attention to that number, you need to know that historically how many shares it's always traded. You can kind of see over here, you have the graph as to what's going on within today, the 5 days previous, the 1 month, and the green on the chart here, 1 month ago and 6 months. And you'll see 6 months, it wasn't trading over here, it's not showing up on the chart. So the average volume, today's volume so far is 1.5 million. The average volume is 3. So more activity is going to be taking place on here. So pay attention to everything over here. The PE ratio, the price earnings ratio, is a big thing, and the EPS, earnings per share. Those are two of the most important ratios that you need to pay attention to when it comes to looking at valuation overall. You see also the market cap, how many shares are out there, and the dollar amount overall. So pay attention to looking at a market quote, get the hang of looking at it, ask questions. If you end up with a broker, make certain that the broker explains things to you on a regular basis. By the way, they don't want to explain things. They want to be the one that's going to make the decision to buy or sell. That's what they want. But you need to pay attention to what's going on. It'll help you a lot. We're going to talk about some specific terminology, and you need to set and take notes as to what's going on. A limit order states a specific price for the broker to buy or sell. I wanted that Kellogg stock. I want it up. I want to be a serial killer with Kellogg. Yes, yes, yes. So when it hits $75, sell, sell, sell. And if it goes down to $72, panic, panic, panic. So you have a limit order. Okay, but so if it hits this number, you tell the broker to buy or sell it. Okay, a fill or kill order. In other words, you want it executed immediately or canceled now. Okay, so fill it now or kill it now. Okay, and then a day order, it's going to be canceled by the end of the day. So if it doesn't reach this, then cancel that order. These are common terminologies that are used. You can do it electronically. If you're not using a broker and you're just using an app on your phone, you can do it that way. Good till canceled order. It's going to be remain in effect until it's been executed by the broker or canceled by the investor. Okay, stop order, sell the order at a specific price to limit the investor's loss. If it drops down to 72, sell, sell, sell. I don't want to be stuck with this dog over here if it's doing that bad. Okay, and then the stop loss, the stop order place to limit a loss on a position. So there's a terminology that you're out there. If you're stock trading, okay, here's the selections that are made in each box. BAC is Bank of America Corporation. You want to get 50 shares of stock, so you want to buy. So you click on the buy over here. On the ticker, you're going to look at the market. Okay, you're going out in the market. You're not clicking limit. You're not market to close. You're just doing the market. And on the ticker, you want to buy on the bottom one over here, fill or kill. So here's the limit. So you want to fill or kill. You make a decision as to what you want to do. That's an example of actually a screenshot from off of somebody's account. On brokerage accounts, if you have a stock broker, okay, you have a cash account. You also typically can have a margin account. This is one of the advantages of working with a broker. Okay, so you have a cash account, which is your money, and you can borrow money from the broker. And by the way, they're going to charge you an interest level on it, but they're going to sit down and front you money to buy stock and and really the intention is for a brief, short period of time to front you the money because they want to get their money back quickly. So the initial margin for stock purchasers usually 50%. You can have 25 or 30, so it depends what you have. So on the margin debt, it's the amount borrowed in the margin account. So pay attention to that. If a stock declines, and you bought the stock and you borrowed money from them, the brokerage firm may ask for cash in the margin account. They call that margin call, and you need to respond very quickly with that. Here's an example. If you purchase $2,500 of stock with 50% cash, your money, and 50% their money, which is the maximum you can do, okay, how far can the stock position decline before the margin reaches that 20%? So really X minus the 2,500 that you actually borrowed from them. Okay, so you have 30. So the price could drop to 35.71 before the broker makes a margin call. So in other words, it drops and you originally had that money, and now the money drops down to 35.71. You lost a little bit of money. Okay, so you got to pay up the broker. Otherwise, they're going to sit down and pay attention to you, and they'll cancel your account altogether. Regardless, you have a cash account. If they need to, they'll just seize your money out of that and sell your stock. So pay attention to what the margin really is doing. When you buy a margin, it's funds borrowed. They're charged interest. They can set a higher margin rate for you without notice. Usually, if you don't pay your bills or that you're risking too much. There's no extension of margin calls. They call you margin calls. You need to respond immediately. They don't give you an extension. If they don't, they'll take your money out of your cash account. The broker can decide which assets to cover to sell to cover the margin. So they may choose the ones that are most valuable, which I would do if I were them. So you can lose more funds than invested. You need to always pay attention to what you're doing in the process. Short sells. Short sells, they sound complicated. You're not owning the stock. You're actually you're borrowing shares from the broker. So in other words, if something is falling, you're betting that the stock is going to fall. That's called a short. Companies hate short sellers. Just in case you wanted to know, sometimes short sellers, they'll talk up trying to get other people to this is the bad company. This is the bad company. So they'll buy 10,000 shares of stock and then they'll say, bad company, bad company. It may not be a bad company. It could be just that they're bad-mouthing the company and hoping that it goes down. And that is a pretty common practice for short sellers because they're saying it's going to drop because of the following 5 things. And you don't know if all 5 things are real or fabricated out there. So you borrow shares from the broker. Okay, you sell for 1,000. It's kind of weird because you don't actually own the stock. Okay, and then you wait. And then if the price drops, okay, you buy for $9.50, but the fact you shorted it means you have the right to sell it for 1,000. So you actually bet that the stock would sell for $9.50, and you put $1,000 there. When your order for sell for 1,000, what that means is that you're betting that the stock's going to drop, and you're going to require somebody else to pay you $1,000 for that share of stock. So you sit down there, you put out there a short for 1,000, it drops to $9.50. It does. You turn around and you return the shares to the broker, and you get $50 for that 1 share of stock. You lose money if the stock prices increases while holding a short position. So pay attention. You don't want to have the price go up. If you're shorting somebody, you want it to go down. So that being said, you want to sit down and say, I want to lose money as best I possibly can. That actually is what's going on with the stock, except you're not losing money. Somebody else is losing money, and you're going to force them to pay you more money for the stock. But they made the decision that they would actually be able and have their stock available to short. That's a choice that they made. So you're in the marketplace and you're betting that the stock goes down. And if it does, you get to force them to pay you the extra money for the short that you purchased from them. So here's an example of it. It's better off looking on row 10, stock price of 10. You can kind of see it there. Okay, the investor equity, it's $5,000. And you're looking at here, over here in the column required equity, you can see the money that you had to put in. So you borrowed $2,000, and now you can see the differences that happens on the equity return as you go up and down the chart in the process as to what happens on a short sell, depending upon where it's at. It looks complicated. It's not. If you're going to get involved in short sales, I would recommend doing it only after you have some experience in the stock market. It looks complicated because it is almost the exact opposite of what your anticipation is on the stock market. You're usually thinking the stocks are going to go up, and here you're betting the stocks are going to go down. And then on top of it, you're going to go through margins to sit down and borrow money on top of that. A couple terms to know in the short: you have a short interest, which is the number of shares sold short in the firm. Okay, the short interest ratio, which is a percentage of the average day's volume, and then also the short squeeze in there. Okay, but it puts pressure on short sellers through margin calls caused by rapid change in stock prices. If it goes up, you better believe that the phone's going to ring off the hook, and you may end up losing your short process that's out there. So regulations out here, I'm going to cover a couple of them. The Securities Act of 1933, it regulated initial stock issues. So really that's involved with the original IPO. You'll see a lot of these are 1930s because, oh yeah, we had the depression then, and the stock market went crazy. People committed suicide over this. That's how involved it was, because people were buying stuff on margins of 1%, 2%, and 3%. Okay, so then you had in 2002 this Sarbanes-Oxley Act. It really tried to make the more honest reporting by the CPAs and accountants. By the Accounting Oversight Board is what they did. So they will have that. So you have a couple of regulations there, and then also you have the FDIC protects funds and banks. You'll have all different things. We had a major thing happen here in the last couple of years when we had one of the banks here, the Silicon Valley Bank, went belly up, and all of a sudden the government, which only insured funds for $250,000, decided to insure everything. And they set this massive precedent that's going to rock us for years to come. I think it was one of the foolish things I've ever seen federal government do, except federal government now seems to be on a different page than reality. So that being said, the FDIC is supposed to protect funds and banks, but apparently now that protection of funds is much superheated now over what is really out there. So reading quotes, terms: limit order, fill or kill order, day order, good to cancel order, stop loss, cash accounts, margin accounts. Oh my gosh, buying on margin and short sells, a lot of different things to know out there. And I recommend only doing a few things at a time until you get the hang of that before you go on to something else. Make certain that you don't lose money over the fact you don't know what it means when you start investing in the process. Be cautious here, because you can make an awful lot of money if you know what you're doing in the market. And it all really comes down to reading the quotes well and understanding what you're buying and what you're investing in on a regular basis. Take care.